Hi, this is Brad Levin, President and founder of Legacy Wealth Partners and Certified Financial Planner. Thank you for taking the time to join me today for our 2016 halftime presentation. Today I'm going to be reviewing the factors that influenced the performance of the financial markets as well as the economy in the first half of the year. We'll also be taking a look at where we are today and our thoughts on where we might be heading in the second half. Before I jump into the material that I'm going to be covering, I'd like to ask you to please take a minute to please read the information here and risk consideration related to investing. In his book, The Intelligent Investor, Benjamin Graham wrote, "The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists." In other words, the old adage, buy low and sell high. It is sound advice, although it's been particularly challenging to follow, especially lately. Stock markets have been jolting up and down. Pundits have been cheering and others naysaying. It's difficult to discern whether we're closer to unsustainable optimism or unjustified pessimism, especially since the U.S. stock market keeps ending up pretty much in the same spot over the past year and a half. The one thing I can say with certainty is that there is a lot of uncertainty. So today we're going to explore what's happening in the financial markets and world economies today. We'll offer our thoughts on where we've been, where we are now, and where we may be going. You may recognize these faces here as our current and former presidential candidates, or at least the emojis of them. Yes, they are looking at you, and they spent the last 18 months or so asking for your vote. In fact, it seems like we can hardly get away from all of the drama related to the presidential politics. As we came into 2016, most candidates had followed the polls and staked out their positions. And yet, investors probably wished that the markets were as clearly defined. Late in 2015, Barron's newspaper explained, "The problem isn't that the S&P 500 finished flat, but that it finished trendless, unable to break far above the 2100 level on the upside or much below the 2000 level on the downside. So as 2016 begins, it's very easy to impose whatever narrative we want on the market." Bears could interpret the lack of new market highs as the underperformance of small company stocks, as signs that the almost 7-year-old bull market was nearing an end. And bulls could point to the stabilization of the price of oil, the potential for the dollar to move lower against other currencies, and the U.S. government's $1.1 trillion spending bill, which could stimulate the economy, all as signs that there might be life left in this aging bull market. Early on, it seemed as though the bears had it right. Investors' concerns about recession, declining oil prices, slower growth in China, and Federal Reserve policies helped push the S&P 500 index into correction territory, meaning a market correction that is a drop of at least 10%, and stocks continued south until mid-February. Just when it seemed that a bear market was imminent, economic data strengthened, oil prices began to move higher, and the Fed took on a more dovish tone. The S&P 500 headed north until the UK voted to leave the European Union on July 2nd in what is now the infamous Brexit vote. You can see this sharp drop in the stock market taking place at the end of June. This dip created opportunities for some investors, and markets quickly recovered as everyone realized that the effects of Brexit would be realized over a long period of time. In fact, if you had gone on vacation and not paid attention to what happened to the stock market during just a simple 2-week span of time before and after the Brexit vote, you would have not think that anything much had changed during that period. Let's take a look at how investors have felt about markets so far this year. Investor sentiment is a fascinating indicator to watch. The American Association of Individual Investors, known as the AAII, polls investors each week and publishes the results. Some analysts have said that the AAII poll is a terrific contrarian indicator, and investors take the opposite position of those polled. Results from the 2016 to-date surveys would seem to support that theory. This chart reflects changes in investor sentiment so far in 2016. You can see that 19% of investors were feeling bullish or optimistic on February 11th, which happened to be the day that the S&P 500 hit bottom for the year. 49% of those polled on that day were bearish. At the end of June, there were almost as many bulls and bears, and 38% of participants were neutral. That's a pretty strong indication that there's a lot of uncertainty about the markets and the economy. One key reason for all this uncertainty is the Federal Reserve policy. Since the December rate hike, investors have wondered whether the Fed's policy would push the United States back into recession, meaning when interest rates move higher, borrowing becomes more expensive and economic growth tends to slow. In fact, weak economic data since December has actually limited the Fed to a single rate hike in 2015 and no rate hike so far this year. The chance of a rate increase at the Federal Open Markets Committee in June was about 1 in 5 until the May jobs report arrived. You may remember far fewer jobs were created than anyone expected. As a result, the probability of a June rate hike fell from 21% to almost 4% overnight. Just a subtle change in the language used by the Fed has experts now speculating about whether we'll see a rate hike in 2016 at all. Take a look at the change in Janet Yellen's positioning related to the strength of the job market over the course of just 1 week. On June 20th, she said, "Proceeding cautiously will allow us to assess growth, the labor market, and inflation." The prior week, she said, "Proceeding cautiously will allow us to verify that growth, jobs, and inflation are improving." In fact, Jim Bullard, the president of the St. Louis Fed, did an about-face on interest rates. He now says that we should expect rates to stay low for some time, and it's possible there'll be just one rate increase through 2018. Regardless, it's important to understand that the first Fed rate hike had little effect on interest rates, and that may mean rates will remain low for a long time. We've already seen rates trend lower this year despite December's Fed rate hike. The Fed funds rate is shown here in purple. The rate hike happened in December 2015, and then since then, rates on 10-year Treasury bonds, colored in teal, have moved lower. Demand for U.S. government bonds is likely to remain high as investors seek better returns than those found in Europe and Japan right now, which are offering 0 to negative interest rates. So why is the Fed wavering? The key issue has a lot to do with economic growth. We are more than 6 years into economic recovery, and real gross domestic product, or GDP growth, which is the value of all goods and services produced in the United States, has been hovering around 2% for a long time, which is quite anemic. Investors hope the growth will improve, but the United States faces some headwinds, as the Bureau of Labor Statistics explained. The U.S. economy continues to heal in the aftermath of the Great Recession. Steadily recovering consumption, investment, and housing assist an improving economy, whereas structural factors such as an aging population limit the prospect for more rapid growth over the coming decade. If we dig a little deeper, you can see the drivers of growth in the United States. GDP, shown in teal, is comprised of 4 primary components. The first is net exports, which made negative contributions during 2015, as well as the first quarter of 2016. U.S. exports dropped sharply in 2015 in large part because the U.S. dollar strengthened relative to other nations' currencies. When the U.S. dollar is strong, U.S. goods become more expensive to those importing from us, and demand often falls overseas as a result. Second factor is gross domestic investment, in orange, which includes money that companies spend on commercial real estate, tools, machinery, and factories, as well as spending on residential, rental properties and equipment, and any change in inventories. As you can see, business spending contributed to 2015 GDP, but detracted from first quarter GDP. Personal consumption expenditures, in red, is far and away the biggest driver of U.S. growth. That's spending by you and I. Government spending in purple also made positive contributions. Now that hasn't been the case in recent years, as Ellen Zentner, the chief U.S. economist at Morgan Stanley, pointed out in a June newsletter. In the United States, the current federal fiscal stance is broadly neutral, after having come through an extended period of contraction. A structural shift in federal support for the economy was the Budget Control Act of 2011, or the sequester as it was known, which put in place budget caps that have resulted in 5 years of consecutive declines in federal government spending. In perspective, the sequester has actually subtracted 0.2 percentage points from annual GDP growth. During the last 50 quarters, the federal government has contributed an average 0.1% to GDP. While government spending has helped us in the short term, many experts believe it may hurt us in the long term if government does not return to a fiscally sound path. In recent years, our elected officials have spent more than the government has received. And as a result, our national debt is growing. A study from the National Bureau of Economic Research found that nations typically see growth slow when their debt level reaches 90% or more of gross domestic product. The median growth rate falls by 1%, and average growth falls even more. The blue line in the deficits and surpluses chart shows the deficit trend has been moving in the right direction. It's been declining. As you can see, getting spending in line with revenue is critical. But enough about our country for now. Let's talk about other countries and how they've been doing compared to ours. Economic growth shown in purple in the United States is compared to that of other developed nations, and our stock markets are doing better than those of many nations. You can see emerging markets have been top performers so far in 2016. Brazil's stock market has performed well despite political scandal and recession. Russia is a top performer as well, even though its economy has been contracting. China has the opposite circumstance. Its markets have delivered negative returns despite strong economic growth. Of course, no one really knows for certain exactly how fast China is growing. China's official statistics agency reported that the country's GDP grew by 6.7% during the first quarter of 2016. That didn't come as a surprise because it's smack dab in the middle of the official Chinese government target of 6.5% to 7% GDP growth. The target was set last year when the government adopted its most recent 5-year plan. Research from the Conference Board indicates that Chinese official growth numbers are actually often incorrect, sometimes higher and sometimes lower than actual growth. The government's goal appears to make the country growth appear to be smoother and more consistent. Unfortunately, though, they have not been able to accomplish that with the financial markets, however. International investors have been encouraging China to exercise less control and let market forces play out as they will. It hasn't done as well as many had hoped, though. During the first quarter, when state-run media made it clear that the Chinese government would not step in to spur the country's economic growth, investors panicked. Markets fell 7% and triggered some very strict stock market circuit breakers that kicked in. The breakers were intended to calm overheated markets, but unfortunately, they actually sparked panic selling instead. Markets closed twice in 1 week, and it wasn't long before Chinese officials stepped in to soothe investors. Barron's reported, China's new normal and willingness to let market forces play a decisive role has been telegraphed even more than the Federal Reserve's December rate hike. Yet a downshift that's both necessary and desirable to right an unbalanced economy is spooking world markets and leaving China's leader in a bind. Weaning China off excessive credit, investment, and import-led growth in favor of services means slower growth, markedly slower, in fact, than the 6.5% Beijing is gunning for this year. But Monday's 7% stock market rout shows international investors want it both ways. The rapid growth, innovation, and disruptive forces that capitalism produces? Yes. The downturn and volatility that come with it? Not so much. Here you see the components of European GDP during 2015. Net exports are dark blue. The Economist reported, dependence on foreign demand carries risks. It places a dangerous drag on recoveries elsewhere. And Europe's addiction to exports leaves it vulnerable to any deceleration in global growth. Were China's economy to slow more sharply or America's to return to recession, Europe too would soon see growth wane. So we are now down to just 2 candidates in the U.S. presidential election. And in fact, they may be the least popular candidates in the last century of American electoral history, if you believe it or not. The Economist built this graph from the results of a Gallup poll. Towards the end of June, as we can see, the favorability ratings for Donald Trump and Hillary Clinton remained in the unfavorable range, with Trump at -33 and Clinton at -13. A theory known as the presidential anxiety theory suggests that stock market may get pretty bouncy through November. The theory holds that volatility increases as the probable winner becomes more certain because people start trying to guess what the winner will do and how the winner's policies may affect the economy. Now, in my opinion, this time around may be slightly different because the market is already showing signs of incredible stability this close to the election, which to me suggests the market is becoming more comfortable with the prospect of Hillary Clinton being the eventual winner. Let's now take a brief look at the performance of some major asset classes for the first half of 2016 and compare them to the performance for the same time period in 2015. Current year performance is shown here on the chart in the blue bars, and last year's performance is shown in red. As you can see, U.S. equities were slightly positive for the first half, foreign stocks were down. Commodity prices have rebounded strongly along with the price of oil coming back. Also, other commodities including gold and other precious metals have also rebounded. One of the strongest performers in the U.S. equity market so far this year has been Real Estate Investment Trust, as designated by the Dow Jones Equity All-REIT Total Return Index. That index performed poorly last year. But this year in general, we're seeing a rebound in the performance of high-income producing investments, those that are also considered low volatility stocks, such as consumer staples, utilities, and real estate investment trusts have been strong performers for the first half of this year. One of the reasons for the rebound in the price of commodities, as I said, is the price of oil has been significantly improving from where it was in mid-February, where it bottomed out at around $27 a barrel. By mid-June, the price of oil was over $50 a barrel. The World Economic Forum explained that oil prices are often thought of as a gauge of global economic well-being. So when the price of oil rises, so do costs in most rich industrialized economies. Thus, a rising oil price can act as a brake on growth. And the reverse is also true. An economic slowdown will likely produce a drop in the price of oil, which can be a financial boon for governments and consumers alike. Higher oil prices are not expected, though, to be a significant issue over the short term. You may recall that in the middle of 2014, prices of oil peaked at over $140 a barrel. So at $50 today, they're quite cheap in comparison. High oil prices not expecting to be an issue in the near term because the U.S. Energy Information Administration projects that the price of a barrel of Brent crude oil to remain in about the $50 to $60 range through 2017. As the price of oil increases, many countries around the world are likely to benefit. If the price of a barrel of Brent crude oil rises to $60 or $80, it'll become more profitable for many countries to tap into their oil reserves, including the U.S., whereas in the recent past it's been very unprofitable for these countries to produce oil at prices so low. Rising oil prices have corresponded with the fall in the value of the U.S. dollar. We show oil prices here in black and the U.S. dollar in green. Of course, the value of the U.S. dollar is relative. As you can see here, the dollar rallied through 2015 and into 2016. This was in part because of the Fed's telegraphed intent to push interest rates higher. Since the beginning of the year, though, the Fed's more dovish stance, moving from an anticipated 3 or 4 rate hikes to possibly just 1 this year, has come in tandem with May's anemic employment report and rising oil prices, which have set the stage now for a weaker U.S. dollar. But that said, a dollar today is worth a lot more than it was a decade ago. A weaker U.S. dollar is good news for U.S. corporations in that U.S. exports become much more attractive to foreign buyers, but it also does hurt other developed nations, like those in the European Union, by making their exports less attractive. And that's not all that's been happening in the European Union. In a surprise result, the British voted to leave the European Union after 40 years of membership on July 2nd. The Economist succinctly described the current state of affairs in Britain as, "It is now a week since voters narrowly opted for Brexit, and the country has seldom looked so wildly off the rails. The Prime Minister has handed in his notice. The leader of the opposition is struggling to survive a coup." The pound hit a 31-year low against the dollar, and banks lost a third of their value before stabilizing. Meanwhile, there's talk in Scotland and Northern Ireland of secession. It is time to snap out of the daze. The country needs a new leader, a coherent approach to negotiating with the EU, and a fair settlement with those nations within its own union that have voted Remain. It is clearly going to take some time for Britain to negotiate its departure from the European Union. Let's talk about what the rest of us may be doing in the near future. Where are we going? Well, if Inc. magazine's forecast is right, we may be laughing our way through life as more and more companies use humor to try to communicate their brands and corporate cultures to us. For example, one airline from Down Under has injected new life into safety videos by riffing on popular movies and featuring celebrities like Bear Grylls and Betty White. Let's take a look at some other things that we might have in store in the financial markets and the economy. How about the valuation in the U.S. stock market today and prospects going forward? Some experts have said that they are concerned that U.S. stocks are too pricey at this point. With the price-earnings ratio at around 19 times, U.S. stocks are certainly at an elevated range relative to the historical price-to-earnings ratio level, but they're not extremely expensive today either. According to the perspective from Schwab, the analysts there are somewhat bullish on U.S. markets, but for various reasons. Quote, "We know discontent amongst investors is elevated from talking to them around the country, but also by continued outflow that they're seeing from U.S. equities. The positive caveat is that there is likely a lot of liquidity on the sidelines, which could be fuel for another market advance. Investor sentiment continues to be one of the standout bright spots in an otherwise gloomy environment. We have been accused at times of wearing rose-colored glasses, but we believe a default setting of optimism has been more rewarding for investors long-term relative to one of doom. This is not a comfortable time for investors, which isn't a bad thing from a contrarian sentiment perspective. We urge investors to stick with their asset allocations, but to use volatility to tactically rebalance. Economic data shows signs of improvement, and the Fed continues to be cautious about tightening policy too quickly, which could aid stocks in the second half." End quote. Well, one famed investor whose perspective does not agree with that of the Schwab analysts is renowned hedge fund manager Stanley Druckenmiller, who at the 21st Annual Son Investment Conference recently delivered a passionate presentation in which he shared his extremely bearish outlook. Quote, "Simply put, this is the biggest and longest dovish deviation from historical norms I've seen in my career. The Fed has borrowed more from future consumption than ever before. The Fed's objective seems to be getting by another 6 months without a 20% decline in the S&P and avoiding a recession over the near term. In doing so, they're enabling the opposite of needed reform and increasing, not lowering, the odds of economic tail risk that they are trying to avoid. At the government level, the impeding of market signals has allowed politicians to continue to ignore badly needed entitlement and tax reform. If we have borrowed more from our future than any other time in history and markets value the future, we should be selling at a discount, not a premium to historic valuations. Quote, "So how can well-respected analysts have opinions that diverge so significantly? Remember, forecasting is an art, not a science. There's a wealth of moving pieces: central banks, governments, markets, currencies, commodities, and more. And a change in any one may affect changes in others. A forecast depends on what the individual organizations thinks is most important, but the reality is that nobody truly knows. And that's why a composition of different perspectives that come up with a composite theory and asset allocation approach is what we believe is most important. Aligning our clients' return needs with risk expectations that are reasonable so that we can make sound investment decisions." As always, there are stock market bulls and stock market bears. But what about economic growth this year and in the future? Economic growth is expected to be slow in many parts of the world during 2016, as you can see here. Forecasts for 2017 show growth slightly improving. For the most part, U.S. economic growth has been low and relatively stable, but there are conflicting opinions about our country's economic health going forward. We certainly see signs of improvement in a lot of areas of the U.S. economy. Notably, we've seen dramatic improvement in the employment market. We've also seen strength in consumer spending. But billionaire investor George Soros sees economic trouble ahead. He's worried that the United States could be caught up in a global recession. Nick Tamros, national economic correspondent for the Wall Street Journal, tweeted about an email he received from Soros. Tamros wrote, quote, "China continues to suffer from capital flight and has been depleting its foreign currency reserves while other Asian countries have been accumulating foreign currency." Quote. Mr. Soros said in an email, "China is facing an internal conflict with its political leadership over the coming year, and this will complicate its ability to deal with financial issues." Mr. Soros said he is more concerned that the continued weakness in China will exert deflationary pressure, a damaging spiral of falling wages and prices on the U.S. and global economies, end quote. In June, the Wall Street Journal reported Soros Fund Management had sold stocks and bought gold and shares of gold miners because Soros is concerned about the potential for global recession and its effect on financial markets. Some Twitter followers pointed out that Soros has been bearish on many occasions, and it hasn't always proved out. In my opinion, one thing I feel fairly confident about is the effect that the Federal Reserve policy will have on the performance of financial markets for the remainder of this year. If we continue to see signs of weakness in China, or perhaps concerning economic data here at home, it's possible that the Federal Reserve may change course and lower its expectation for raising interest rates for the near future. This could be a positive for stocks. We'll just have to wait and see. We can't be certain about when interest rates will go up, and we can't also be certain about how additional rate hikes will affect the yields on bonds. But BlackRock's managing director warns when rates move higher, the cost to investors could be significant. He quotes, "The taper tantrum in the spring of 2013, which saw the 10-year Treasury yield move sharply higher, surging from 1.62% to 3.03%, provides a sense of the risk that traditional fixed income investments face and the potential for loss of principal in today's bond market. However, the risks in the fixed income market have actually increased. The size of global central bank balance sheets have ballooned from $8.3 trillion to $11.4 trillion. Inflation in the U.S. has pushed higher, and the percentage of negative yielding bonds in the world has expanded from 0.5% to 23%. As we don't know when interest rates will go up or what impact rising interest rates will have on U.S. Treasury bond yields, the reality today is that negative yields elsewhere in the world may keep demand for U.S. bonds high and hold yields steady, especially if the Fed doesn't raise rates until December or even next year. The Wall Street Journal reported, quote, "Investors' hunt for income has become intensifying amid a broad decline in global bond yields in June. The U.S. Treasury debt market is one of the few places left in the developed world offering relatively higher income. Meanwhile, the pain is growing among global investors in a world awash with a record amount of negative yielding bonds, driven partly by unconventional monetary stimulus in Japan and Europe." Quote, "And that was before concerns about Brexit drove investors to move assets to treasuries. Today, we have an unprecedented environment in which 2/3 of the world's government bonds have yields below 1% and approximately 1/3 below zero. That's why the prices of U.S. bonds continue to move higher, despite the fact that interest rates are already so low here in the U.S. One investment area that we find particularly interesting right now are opportunities outside of developed countries in the world. Emerging markets investment guru Mark Mobius recently wrote, quote, In our opinion, the long-term investment case for emerging markets remains positive for a number of reasons. Economic growth rates in general continue to be faster than those of developed markets. Emerging markets have much greater foreign reserves than developed markets, and the debt to gross domestic product ratios of emerging markets generally remain lower than those of developed markets. Emerging market countries account for nearly 3/4 of the world's land mass and 4/5 of the world's population. This presents considerable potential in terms of resources and demographics and look to be in a strong position to potentially benefit from technological advances. Quote, this could bode well for emerging market stocks as well. In fact, we've seen considerable underperformance of emerging market equities now for years relative to the US market. But we could see a change in the tide and a reversion to the strong performance of emerging market equities in the near-term future. But here's the most important thing to remember. No matter how much doom and gloom, no matter what market is being discussed, there are almost always opportunities. And sometimes those opportunities are actually created by volatility. Earlier this year, when US stocks dropped, investors had opportunities to buy attractive companies at lower prices. When oil prices dropped, opportunities were created. In any market, in any region of the world, there may be opportunities to invest in stocks or bonds of attractive companies, no matter what direction the market is headed. Unfortunately, though, emotion can make it difficult for investors to buy when investments are at lows and sell when investors are at near highs. Financial markets are the only markets where things go on sale and all the customers run out of the store. Our goal in working with you is to outline a plan for us to follow that will align your goals with your financial resources and get you from point A where you are today to point B where you want to be in the future. And ultimately, that's why we're here. It's been estimated that the right wealth management plan, properly executed, can translate into as much as a 3 percentage point increase in net portfolio return over the long term. The largest component of that increase, potentially 1.5%, comes from helping clients maintain a long-term perspective and a disciplined investment approach. I can assure you, no matter what the rest of 2016 holds, we will be here to help. We will monitor economic and market developments closely, but we won't let the noise of day-to-day events determine our choices. We will not take action until our discipline process indicates that we should. We have confidence in our process. It's the reason that we sleep well at night, also so that you can sleep well at night, and more importantly. Do you have any questions on what we've covered here today? If so, please feel free to reach out to us. Thank you for listening today and for your continued support. Our office address and contact information can be found here.